So, in introducing our next speaker, Mariana Vitorino, let me tell you a little bit about her. So she does research using game theoretic models to examine the effects of different kinds of firm strategies on consumer behavior. But she's also interested in looking at the intersection of research on marketing and finance. So, for example, she's been looking at the effects of advertising on firm value. But she also has a secret life as a bicyclist. She is now at the University of Minnesota, but before this she was at the Wharton School at the University of Pennsylvania. And in fact, she bicycled competitively for the University of Pennsylvania. And for those of you who've been following the saga of Lance Armstrong and what's been happening, the mess that the International Bicycling Federation is in, maybe we actually need people like her to fix things. Because this morning when I was asking her, is there something interesting or fun that I can say about you? She chided me. There's nothing fun about me at 7 a.m. on Saturday morning. So here's Mariana. And she's going to talk about advertising, consumer awareness, and choice evidence from the U.S. banking industry.
Thank you. Well, thanks for coming here. I'm very happy to be here and to present some recent research I've been working on with Elizabeth Honka at the University of Texas in Dallas and Ali Ortasu at the University of Chicago. And what we are interested in with this specific piece of research is to understand the role of advertising throughout the different stages of the consumer purchase process. And we do this analysis, or we do apply our study, our research question to the banking industry. Well, the retail banking industry is a very large industry, as we know. If I ask you in the spirit of polling, like we've been doing in this conference, how many people have a checking account in this audience? Okay, that's what I expected, okay? And if I ask you how many people have opened a new account in the last couple of years, either it's a mortgage account or a loan account or some kind of credit account, checking account, okay, that's what I expected too. Okay, so basically, there's a lot of activity going on, and we want to but unfortunately, there's not a lot of academic research that tries to disentangle or look at the different effects of advertising throughout the different stages of the consumer purchasing process. So that's basically what we try to do. And let me start with a simple scenario or situation. Let's say we observe a given consumer choosing bank A over bank B. Okay, I'm not going with names here. There's two alternative explanations for why this happened that come up to mind. Okay, one is that the consumer may not even know of the existence of bank B, and hence it went with bank A. The second one is that the consumer does not like bank B for some reason. It doesn't like the interest rates that the bank offers. It doesn't like the fact that there's no branch close to his home for a variety of reasons. Now, as a marketer or as a manager, are we interested in understanding which one is the reason for the consumer not choosing the bank? Yes, we are, because different reasons will lead to different strategies, different managerial implications in terms of decisions such as pricing, advertising, and so on. I mean, if you have the best interest rates in the market as a bank, but people don't know about you, lowering the interest rates or increasing the interest rates further in terms of checking or savings accounts, it's not going to make you more popular. It's not going to make you increase market share. So it's really important to know kind of what is driving your customer base and how you're acquiring your customers. So in this paper, we are focused on the specific role of one of these tools, advertising. Okay? And we look at advertising as having two roles. On one side, on one hand, advertising may affect consumers' awareness. That is, it affects our understanding of how many options we have available, which banks are available to us when we want to open a bank account, okay, what are the different hypotheses or the different types of products. So I call this the informative effect of advertising. On the other hand, advertising can also in some way persuade you to go with a given bank. So conditional on you knowing of a product, or of a bank more specifically, I can try to persuade you to buy from me by using advertising. So advertising has these two distinct roles, persuasive and informative. And one of our main research questions is actually to disentangle these two effects and measure which one is more prevalent. And at which stage, and basically for which types of banks. So it varies depending on the bank, of course. So that's one of the goals of our research. Now, this turns out to be not a very easy question to answer, as you may see, because there's a lot of things that affect consumers' decisions to go with the bank. It's not just about advertising. So we need to take all these other things into account. And further, it's not easy to just do a survey and ask the consumer, okay, do you think that you chose this bank because you knew about it, or you were persuaded about it, or a combination of both, and which one played the biggest role? 80-20, 50-50? I mean, this is not something you can ask in a survey, right? So we try to look at consumer data, a combination of consumer data with survey data, and try to infer this from the consumer's decisions. So because there's no way we can ask the consumer directly about this, okay? So we construct this structural model, and Mitch has already introduced that, called structural model regression on steroids, okay? So there you go. I'm going to go with the regression on steroids again. And basically a mathematical model that's going to take into account the different stages of the consumer purchasing process, and it's going to model those stages and kind of see where's the role of advertising at these different stages, controlling for everything else, so taking other things into account. This is still work in progress, but so far we've found quite robust evidence for a primarily informative effect of advertising as opposed to persuasive. So a bigger role in terms of getting the consumers to know about your bank. But with some exceptions, Bank of America, for example, and I have Bank of America here. So Bank of America is an exception where actually the role is mostly persuasive, and I'll talk more about that later, but I think primarily it's because most people already know about Bank of America, so there's not a lot to inform people about. And that's basically what we find in terms of informative versus persuasive effects of advertising. Now, I've already given you the motivation for our research question, what we are trying to find out. Now I'm going to guide you through how we did this, okay? Not in a lot of detail, but I'm going to guide you through how we did this. And for this, it's really important to have good data, okay? Big data, small data, but above all, good data, okay? So we have big data, we have small data. We actually have 4 data sources that we use, that we combine to construct our kind of our major data. And the main data source is actually a survey that was conducted by a well-known market research company that I cannot disclose the name for, and for which that tracked consumers, or that asked consumers a variety of questions regarding whether they had switched bank accounts, what kind of bank accounts they opened, so what did they do in terms of their banking activity during the last year. And this was conducted in 2010, and there were 2 main types of consumers in this, or respondents in this survey. So there were people that opened bank accounts, and people that were not shopping for bank accounts. So they were kind of, they were probably happy with their banks. And it's really important that we account for these people, because these are people that are not even looking for other things, and there's a reason why. Probably because they are satisfied with their current options. So we need to kind of account for these people. Now, the second set of, we complemented this main survey data with several pieces of information. So one, we got big data from RateWatch, which basically collects rate information for many branches in the U.S., or most branches in the U.S., and fees and accounting types, branch location. So we have kind of information regarding what types of rates were available for the different branches close to each of the respondents. So we actually matched the respondent's zip code with the branches that were around these locations, so that we can have an idea of what were the rates that they were aware of around them. We also collected data on advertising from Kantar Media. So we use a database called AdSpender, where we basically have advertising expenditure by bank, by designated a media area, which is an area designated by Nielsen, which basically comprehends consumers that are, or refers to consumers that are subject to the same types of media exposure. There are about 200 DMAs in the US. It's relatively comparable in size to MSA, okay? Metropolitan Statistical Area. And we also have advertising expenditure at the national level for a variety of media. And we also looked at bank branch density, okay, because this is really important for consumers, we find, to have a bank branch around them. And so it was important for us to, again, see for a given respondent in a given zip code what kind of branches they have available for each bank. Okay, so these are all the data sets, all the ingredients that we combined to answer our research question. Now, in our main survey data, like I said, what do we have? We have, and this is really crucial for the study, we have respondents saying which brands they were aware of, okay, and also which ones they considered when they were thinking, if they were thinking of opening a new bank account. So this is really important because this helps us to kind of track the influence of different things at the different stages. Okay? And then we also know which bank they ultimately decided to go with. And then we have a bunch of demographics, age, marital status, income, so on and so forth, and which one is their primary bank, and some brand attributes. Now, there's a lot of interesting things in the data. I'm just going to highlight a couple of them. We see that, for example, in the data, the average awareness set size. So if we ask the consumer, and it's important that I say that we focused on the 19 largest banks in the U.S. because these were the banks that the survey focused on, so we focused on those. And among those, we see that the average awareness set size in the consumers, in the respondent survey, is about 7 banks. Okay, so on average, consumers are aware of 7 banks, but there's a lot of variation, as you can see there. I mean, there's consumers that are aware of only 2 banks and consumers that are aware of 15. Okay, so a lot of variation. And we need to take this into account because, of course, advertising is going to play a different role depending how many banks you're aware of already. Okay? And we also have an idea of which banks they considered. On average, consumers considered 2 banks. There's also 20% of consumers that roughly considered 3 banks when they were thinking of opening a new bank account. Okay? But the important thing here is that they are small, relatively small, and there's a large variation across respondents. Now, more importantly, can we infer awareness from consideration? I mean, do we really need to look at the awareness stage, or can we just look at the consideration stage, or can we just look at the awareness and forget about consideration? Why do I need to look at both? Well, it turns out that one is not predictive of the other. So the fact that the respondent is aware of more banks does not mean that the respondent is going to consider more banks when he's thinking of opening a new bank account. So it is important to take these 2 into account. You cannot just focus on one of them because they're going to have different implications. So that's basically what we see here, that there's, again, a huge variation, but there's a very small correlation between the two set sizes. Also, very important, we cannot predict which banks are in the awareness sets or in the consideration sets based on the data. So basically, or based on the awareness. There's very different conversion rates for different banks. As an example, we see that, for example, Bank of America, which is a bank, I think its awareness rate is about 94% or something. We see that the percentage of people that are aware of the bank and that then include it in the consideration set is 47%, but then out of those that consider it, only 29% purchase. Okay, so that's kind of the conversion rate as you go to the purchase funnel, kind of how consumers kind of you're losing your consumers, so to speak. On the other hand, for example, other banks like Comerica Bank has a very low transfer of consumers from awareness to consideration, but 50% of those that consider opening an account with Comerica end up opening an account with Comerica. So very different conversion rates for different banks. So again, really important, and that's I'm trying to motivate why it's important to take into account all these stages and model them precisely instead of just looking at overall number of banks that the consumer was aware or overall number of banks that the consumer was considered. Another fact in the data, which is really important, is that there's a huge variation in terms of bank branch location. So if we look at different banks, Bank of America is pretty much everywhere, but many banks are highly localized. Okay? So we don't have an homogeneous presence of banks in the U.S., So it's really important, and this is correlated with market share. So of course, locations where bank has more branches, typically it has more market share. So it's really important for us to really take into account this variable very carefully, even if we are interested in advertising ultimately, but we need to take into account the bank presence in order to kind of measure advertising precisely. Okay, so I already said this. Okay, so in terms of advertising expenditures, like I said, we look at advertising expenditure at the designated media area level. So there's, again, huge variation in spending across banks. And many banks don't even advertise on all DMAs, which makes sense because maybe they don't even have a branch there. They feel that people are not going to go and open an account there anyway, so that makes sense. And what do these banks spend more money on? So we look at a variety of different types of advertising, but we don't consider all types of advertising. We look at TV, newspaper, internet, outdoor advertising, magazine advertising, and I think that's pretty much it. Okay, so if there's any other like direct mail, we don't account for that, so we don't look at direct mail advertising. We're actually thinking about doing that, but that would require another data source, so even bigger data. But so far, these are the ones we've been focusing on. And TV seems to, between TV and newspaper, it seems to take most of the share of the advertising expenditure. So the key data takeaways at this point, and that's why I showed you all these descriptives, is that awareness and consideration matter. So it's important to take these two things into account instead of looking at just one versus the other, because respondents are very different, and banks are very different in terms of their conversion rates. We cannot predict awareness sets, and physical presence is really important and indicative of choice. So we need to take that into account if you're going to build some complicated mathematical model, regression on steroids model. We need to take these things into account. So our model basically is a model that models these three stages of the consumer purchasing process: awareness, consideration, and purchase. Okay. So awareness is in some way passive, right? The consumer does not exert any effort. You're either aware or not of a bank, and that is a function of things like advertising, demographics, and bank locations. Okay? So those things contribute in the model to increase your awareness of a bank. Now, consideration is a little bit different in our model. We allow the consumer to exert effort in order to consider a bank. So basically, a consumer, once he decides to consider a bank, is going to exert some effort to learn more about that bank. So as soon as I include you as a bank in my consideration set, I'm going to have to go to the branch, or I'm going to go online. I'm going to find out what your rates are all about. I'm going to see what your fees are. So there's going to be some search cost involved into my decision. So that's really important because it turns out that search costs can influence consumers' decisions, and if they are really high, you may search less because of that. So it's really important that we take this into account. So that's why consideration is active. Now, on the other hand, purchase is active but effortless. So once you have collected, so basically think about this as you being aware of 8 banks. Then, for example, you consider a smaller set, let's say a set of 3. Then you go and collect information on these 3 banks, which are in your consideration set. As soon as you collect this information, you are able to make a decision. Okay? So it's effortless in the sense that you don't have to collect any more information. You already have everything laid out for you. You just pick one. Okay? So that's what the purchase stage is all about. Okay? And then the consumer purchases the bank that gives him the highest utility in some way, which is a function of different things, like, for example, branch location, distance from branch to home, that sort of thing. So this is just some Greek letters, and for exactly to show the different stages. And again, like I said, the important thing to take away is that consumers' awareness is a function of things like advertising spending, demographics, and things like whether there's a branch or not around you. And ultimately, what's going to drive your utility is not just advertising or location of branch, but also interest rates. For example, I mean, once you collect the information, when you're kind of thinking, your awareness set is influenced by advertising branch location, but not necessarily by interest rates, because that's something, or more detailed information, because that's something you collect during the search process, okay? Once you have considered the bank, okay? So that's basically the stages. Okay, I'm going to skip this. So far, what have we found? We found that advertising seems to play a bigger role in awareness than in choice, like I told you. So there's a bigger role, a bigger awareness role or informative role of advertising. Then it's more informative than persuasive. And this varies by bank. So if you want to look at the paper, there's detailed information by bank. So for example, Bank of America is a notable exception, where the effect of advertising is higher on choice than on awareness. We also see that, yes, so basically, but if you take the average across all of the 19 banks, we see that the effect is higher on awareness than on choice. Okay, I'm going to skip this. What else do we see? We also see that physical presence matters a lot, and that consumers, it's the largest awareness shifter, even more than advertising. So the fact that you have a bank around you makes you more aware of the bank. And it's very important, has a larger effect on increasing consumer awareness for smaller than for larger banks. Kind of makes sense too. We also see some interesting patterns in terms of demographics. So some types of consumers are more aware of more banks or fewer banks. So those are some of our conclusions. When we look at the choice stage, one important variable that we account for is this inertia variable, and it seems that there's a lot of it. Okay, so consumers favor opening an account. They favor opening an account with their primary bank. Right? So if they already have a primary bank that they go with, there's a huge preference towards opening another account with that bank. Okay, so there's a lot of inertia. This idea of convenience and one-stop shopping. If I already have a checking and a banking account with this bank, might as well get my mortgage from this bank as well. And we find that consumers are sensitive to interest rates, so they do care about interest rates. So there are, the higher the interest rates for, in this case, savings account, the more likely you are to open an account with this bank. Physical presence, again, very important for choice. So it's important not just for the awareness stage, but also important when you're thinking about which bank to choose. It's very important to you kind of have a bank close by, even if you're not going to use it, or to have a branch close by, because you may need to kind of ask for a cashier's check or something eventually in 5 years, but you may need it. So it's important to have something, a branch around. And search costs are not very high, but they are there. So basically, we see that consumers, if a consumer is thinking of depositing or making a $10,000 investment, we see that there's basically a $10 search cost that is associated with the fact that the consumer is collecting information about different banks and gathering this information so that they can make an informed decision. So in summary, we see that, we know that consumers are aware of about 7 banks, but they only actively consider 2 of them when they are thinking of making their decision. And when we think about the purchase funnel and how different variables affect the consumer's decisions, we see that advertising is informative for most banks, exception Bank of America. Local bank presence is really important, both for the awareness stage, so for the consumer being aware of a bank and include it in the awareness set, but it's also important for choice. Okay, so for you to move from being considered to being chosen, it's really important that you have local bank presence. And we see that search costs in general are small, but they are significant. So there is some search costs associated with consumers finding out more about the given bank and including it in their consideration set. And I think that's it, pretty much. Okay, thank you. We have 1 minute for questions.
Hi, Tess Bradford, Bank of America. I have a question.
Okay. I saw that coming.
Yes, you did. I appreciate your research, and I thought it was very informative. Couple things,
Not
and
persuasive.
I'll keep it very brief. Yes, quite a bit of perspective I can add to this. I'd like to see how your data would change based on up to 2004 information, because the entry of mobile has been a game changer. Mm-hmm. So and I won't go into the details why. And also, I'd like for you to consider things like the landscape of the business. Mm-hmm. There have been some significant mergers recently, since 2010 actually, and the impact of community banks and credit unions has been an interesting change to the landscape. But definitely look at the new data out there now, because things have changed since 2010, and mobile.
So that's a limitation of our study. We don't account for credit unions. So our banks, the banks we account for, like I said, top 19 banks in the U.S., roughly 80% of total assets in the banking industry. So we feel it's somewhat representative. And in terms of the change for mobile advertising, I can
just the use of mobile. So services are key in our industry. Mobile banking, mobile check deposits, virtual ATMs. They've sort of shifted the landscape of the input into the consideration set for customers.
Okay, so you think that's an important decision variable for the consumer?
I know it's very important.
So thank you. So what we can do, and I'm sure we actually have this in the survey, is actually consider that in our model and incorporate the fact whether or not one of the reasons for opening an account with this bank was the fact that it has a good mobile and online presence. Okay, so that's something we can definitely do. Given what you're saying to me.
Oh, very interesting. Thank you.
Okay, thank you. Thank you.
One more. Just one more. Sorry.
Okay.
Thanks. Okay, really briefly, what implications do you see then for the content of advertising? If you feel that advertising is more informative than persuasive, it sounds like adding a rate would be good, but adding a rate comparison chart may not be good because it's not influencing choice. What is your thoughts on that?
It would depend on the bank. And here we are not controlling for the content of advertising. So when we are here measuring the effect of advertising, we are just looking at advertising spending. We are not looking at the content. That is a very good question. We actually just got some data from Compare Media in which we actually have access to the content of the ads that these people saw in their area. So we are actually thinking of seeing what is the effect of the different types of advertising and what the content in those ads changes their consideration and awareness sets. So I cannot speak to content because we don't have content data. We're just looking at total expenditures and how it affects consumers' decisions. Okay? Thank you.